Hey guys, hello everyone, good evening friends. Today is February 12th, 2026. So today's major indices, man, it's brutal, absolutely ugly. Yesterday in the comments, we already told everyone the alarm bells are ringing. Yesterday's key focus was underlining that twice, alarm bells ringing. So why did we call the alarm yesterday? First, it's still based on fundamentals. This AI disruption to entire industries, and the signs of that disruption showing up, I'll break it down in detail for you guys in a bit. This emergence is a process, from quantity to quality, a tipping point. But the market has already given its feedback. Tomorrow's CPI data release, it's going to have a pretty complex impact on overall market confidence. From yesterday's non-farm payrolls to tomorrow's CPI, there's a digestion process happening after hours for everyone, because tomorrow's CPI is an asymmetric bet, totally lopsided risk-reward. What do I mean? If tomorrow's CPI comes in good, meaning inflation isn't running hot or even cools further, I don't remember the exact numbers, maybe 2.1, 2.0 or below 2.1, the market would see that as totally expected, no big surprise. A drop in CPI wouldn't change the fact that rate cuts are probably still delayed to June or even July or later this year, right? So even if CPI is good, the bullish impact on the market is actually pretty limited. But if tomorrow's CPI comes in bad, and we have a ton of reasons right now to suspect it could run hot, because a lot of 2026 economic data is at risk of being revised upward. Plus, yesterday's non-farm was super strong. Employment market is rock solid, unemployment super low. So the market might start guessing, are we in a stagflation cycle right now? Everyone knows in economics, if you're in stagflation and inflation spikes, not only do rate cuts go out the window, there could even be a new hiking cycle. This isn't fear-mongering. The probability isn't huge, but we could enter a complete rate silence period. That would be a massive hit to the market. Everyone's already dumping software stocks, right? There's already worry about whether the whole market has a bubble, some froth building up, and a bit of concern about future interest rates in general. You've seen big money constantly rotating, big bricks moving, funds shifting around nonstop. So yeah, this is a classic asymmetric setup. If data's good tomorrow, no inflation scare, the market just does whatever it was going to do anyway, up or down, no big change. But if it's bad, the downside hit to the market is huge. We know rate cut expectations are layered with several factors. First, economic data has to be strong to even enter a cutting cycle, right? Second, the new Fed chair coming in. It's basically locked in now. Kevin Warsh is taking over. This new Fed chair, he has to be dovish on economic policy overall for things to loosen up. But right now, he's a balance sheet runoff advocate. What does that mean for the Fed? It means his threshold for intervention is super high. If the economy or stock market tanks big time, he won't jump in lightly. He'd only act if things are already extremely ugly. No easy, let's cut rates and bail out the market mindset here. So with all these layered worries, the market gave its answer today. And yesterday, we already sounded the alarm. The main reason we rang it was because of this. All right, guys, today let's talk about this AI disruption across entire industries. Might be a bit lighter on technical analysis today. This AI disruption to industries, it's happening little by little, one sector at a time, picking them off one by one. For example, at the very beginning, it hit education hard, right? All those tools where you need to search for data, traditional edtech software, it took a real hit. Then the second wave hit the most traditional labor-intensive software sectors, like stuff that needs humans for data labeling, customer service, even CRM tools, customer relationship management software, right? All of that could get completely disrupted by AI software. See, it's happening step by step, guys. First, it disrupts these tools. Then recently we saw agent workflows emerge, like what Anthropic did with Claude's coworker features, right? What is it really doing? It's replacing all those personal PC-based workflow software tools. So for all SaaS, subscription-based software, there's this doomsday feeling, right? Some people say, nah, it's not there yet, maybe just hype, but they're wrong. What I want to tell everyone is, this is absolutely a disruption to the entire software industry. Looking ahead, here's my call for you guys. In the future, the economic value generated by AI agents will definitely surpass the total economy created by all humans. That's over the next few decades, but we can already see this deterministic future coming. So yeah, these software companies are definitely getting disrupted, right? But right now we don't fully see it. It's starting with the ones we can imagine. Labor-intensive, data-heavy stuff that requires tons of data searching. Like legal advisors, right? Just yesterday, some wealth management stock dropped 10% because a tool came out that automatically handles tax planning and personal financial planning for you. These were things humans used to do. Integrating data, using what seems like high adaptability, adjusting based on real situations. But actually, AI can already do all of this, and it's doing it now. So the disruption from AI to traditional industries is massive. That's why yesterday we talked about left side versus right side. Left side is all the traditional industries that could get disrupted by AI. Right side is the industries that benefit during AI's development. So we've been telling everyone all along, you gotta pay attention to semiconductors. That's why yesterday we showed you one stock, Vertiv. We talked about how Vertiv does liquid cooling. It gapped up yesterday, and today it's still holding up high. No major pullback yet. But look at the chart. This gap might get filled in the short term. It could try to come back and close it, but we still believe, no matter how much other software stocks get disrupted, right? As long as AI keeps developing, it needs compute power, and compute power absolutely needs cooling, right? This cooling sector has super high certainty. Everyone needs to watch this closely. All right, let's get back to the indices first. Today, let's look at the NASDAQ. This candle is really ugly, guys. It basically ate up those two rebound candles from before, completely swallowed them. After eating them, now we have to watch 22,500 below. We've mentioned this level over and over. It's super important, really key. Hold on, let me zoom in. Look right here. This level is critical. The low of this line is extremely important. Once it breaks, especially on a close. What do I mean by break? Close below it. Not intraday wicks, but a closing print below this level. That would be a really ugly chart pattern. Let's ignore the moving averages for now. I cleared them off the chart today. Just focus on this line, just the lows of these candles. This point is crucial. So high probability. If this AI industry disruption keeps fermenting, in my view, the market's going to look pretty rough going forward. This could be forming a top right here. So the alarm keeps getting upgraded today. Yesterday we said it went to level 5, maybe already turning bearish. Wait, yesterday was level 2, right? Today we're bumping it up to level 3. NASDAQ is the core main driver of this whole rally. Everyone pay attention. If NASDAQ breaks, the hit to the entire core theme would be massive. Today's key thing, the Dow also dropped back below 50,000. Why below 50K? Because today's US existing home sales data came in way down, sharp drop. That sparked worries about a potential recession in the broader economy. US home sales are a really important real economy indicator. Big drop makes people think, is a pullback coming? And layered on top, concerns about the US government cutting the deficit. You know, that Doge thing Musk was pushing, Department of Government Efficiency, it's already starting some pretty aggressive moves. So that impacts companies like Cisco. Their main orders are enterprise related, right? And they rely heavily on enterprise expansion for their business. So today it tanked, down 12%. Everyone knows Cisco is a core player in infrastructure. Tech infrastructure, right? It's the undisputed leader in this space, super well-known company. So its massive drop is hitting the market hard, especially dragging the Dow down big time. So as you can see with the three major indices, exactly like we said yesterday, look at the S&P, it's already formed 3 tops, and those tops are getting lower and lower. We explained yesterday why we rang the alarm. The S&P is actually the most neutral, most comprehensive gauge. You might be trading NASDAQ for the growth story, confidence from the Dow for the economic fundamentals, but whether you're trading ETFs or watching the real economy's core indicators, the S&P 500 is the most balanced and comprehensive reference point out there. So look, not only has it perfectly confirmed a top pattern, and guys, pay attention, we're looking at the daily chart right now. On the 4-hour chart, it's even clearer, right? Way more obvious on the 4-hour. On the 4-hour, where's the key level? Right here, the bottom of this line, exactly this spot. This level is 67,800 right here. If this gets broken, just like with NASDAQ, we might witness the birth of a short-term bear market today. Not necessarily a long-term bear, because the semiconductor sector is still super strong. AI has to keep developing. Look at Amazon, Microsoft, Google, and even Cisco, like we just mentioned. They're all pouring massive money into infrastructure this year. Where's all that money going? Straight into semiconductors and everything related. That's why we recommended a few stocks before, like MU, Micron. See? It hasn't really dropped much. Still consolidating up high, maybe a little dragged by the broader market, small pullback at most. But overall, the chart is still super healthy and strong, just like that. Micron is also in semis. Nvidia, like we talked about before, it's got this beautiful upward head and shoulders pattern, moving really well. It has plenty of room to correct and handle any index downside, tons of cushion left. So guys trading indices or ETFs, pay close attention. This spot is extremely dangerous right now. Today's action across the 3 major indices and related traditional software stocks is very risky. But if you're holding stocks we've been recommending all along, like Tesla, it's not traditional software getting disrupted. No, it's autos, new energy, AI, even space concepts, right? Stuff like that is fine. Even Google pulling back is good. Discounted price for one of the core big model players. More investment in those models is a positive thing, right? So core AI concept stocks, semiconductor names, hold them tight. But everything else, alarm bells ringing, ETFs ringing, indices ringing, that's the share for today. See you guys tomorrow.